QuickBooks Pro Desktop 2021. Multiple currencies, accounts payable, reversing entry. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our multiple currency practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We're going to take a look at the accounts payable that is resulting when we made a purchase of inventory on account and that we're going to be paying in foreign currency. So we're going to go up top to the reports. We're going to go to the company and financial, take a look at the balance sheet standard. Balance sheet standard. Changing the dates up top in the customized reports from 01/01/21 to 12/31/21. We're going to say then okay. And then we're down here, we're looking at this accounts payable down here with and it's in foreign currency. So we're going to be paying, in other words, in foreign currency. This is the US currency equivalent. So we bought inventory. We put it on the books when we bought it with a bill on 11/16/21. And we used even though we're going to be paying 20,000 units of foreign currency, we valued it at that point in time using that spot rate as of that point in time to the US dollar equivalent, 33,000. Then at the end of the year, we needed to make the financial statement. So we got to make the financial statements, therefore revalue our accounts payable, which we had not yet paid yet. We're going to pay it sometime in the following year. And we have to value the accounts payable using the spot rate at that point in time so that we can record our financials properly as of that point in time. So that was a change of $400, taking the payable to $32,600, even though once again we're going to be paying in actually foreign currency, which is the 20,000 foreign currency units. Then if I go to the profit and loss, reports drop down, company and financial, take a look at the profit and loss standard, changing the dates from 01/01/21 to 12/31/21. We then have within our exchange gain and loss that $400 that was recorded in the current time period, and that's what should happen. We want to reflect that $400 in the current time period. Now, when we actually pay this thing off, it's going to happen next time in January of 2022 in the following year. So let's take a look at what we did in Excel then. We're in Excel here just to see this in a kind of a more transparent way. We then said, okay, now we're going to go down to year 2, where we have like a new income statement, the prior income statement rolled out into the retained earnings. And we revalued it using this transaction up top. We revalued it to the date that we're going to be paying it on, which is January 15th, using the spot rate at that point in time, which resulted in in this case, a loss in the current year. So now we have, according to this transaction, we got a couple dates that we're dealing with, right? We had the starting date that we made the actual purchase. End of the year, we had to make an adjustment for that spot rate date. And now we're down here and we're going to be paying it off. And so we have a third date so that we had to adjust this to, so that we then got the proper amount of US dollars that we would have to then spend to get the proper amount of foreign currency units, 20,000 British pounds in this case, to pay it off. Now, we didn't record this side of the transaction in QuickBooks. We just did basically the foreign currency unit transfer. This side of the transaction will basically be recorded when we do the adjusting entry, reversing entry, and then payment of the bill. So this will all hopefully fall out and make sense as we go here. So up top, notice we had 400 gain recorded up top. And then we have 200 gain or loss recorded in the current period. We want that same result, but we're going to do that with basically a reversing entry kind of technique in QuickBooks. So we're going to go back to QuickBooks and say basically what we have here, if I double click on this, is this journal entry that was put in place. I want to reverse that journal entry as of the first day of the following period. So I'm going to double click on that journal entry, and here it is. And so I put it in there to make the books right at 12/31. I'm going to reverse it as of 1/1. So I'm going to say next, and I'm going to say this is going to be as of, I'm going to put it the day after, not the day that we're going to make the payment, but the day after. I'm just going to reverse it exactly, and that's going to be then for the exchange gain loss. It was a credit before. It's going to be a debit now because I'm reversing it. And then the other side, we probably would want to put in the memo that this is a reversing entry. And then the other side is going to go to the accounts payable, making sure it's the GBP accounts payable. and okay, and that's going to be going. We have to have the vendor, which was vendor 3 GBP. That's the vendor. Those have to match, of course. The vendor has to be in the same currency as the accounts payable account that we're doing. We're doing it as of the first day after the cutoff date, first day of the new period. So I'm going to say save and close, and yes, and let's see what happens now. So if I go into the profit and loss then, and I entered this then as of the next day or the next year, so this is going to be 01/01/22 and so now we've got that $400 loss in the next period. Notice that that does not tie out to what we have here. It should be a $200 amount. We just reversed the entire thing. But then what's going to happen is the next thing that's going to happen here is we're going to go into the home page and we're going to pay the bill. And when we pay the bill, QuickBooks will typically record a transaction that will record the difference between the spot rate at the point in time we entered the bill and the spot rate when we paid the bill. And when we do that, it will net out against this $200. In other words, when we record the transaction, let's pull out the trusty calculator. It's going to be taking the two spot rates here and here. The original spot rate, which is the 1.65 minus the spot rate when we pay the bill, 1.64, and that's a difference of 0.01, and then times the 20,000, that's going to be 200. That 200 then will net out against this reversing entry. So it'll net out against this reversing entry, and then we will be correct as of that point in time. So we did the adjusting entry in the prior period. It's correct. This one is wrong because it's the 400. It's wrong until we actually make the payment of the bill. And when we make the payment of the bill, then it'll wash out to be the correct number. That's kind of how the adjusting and reversing entries will typically work. Also note that we did the reversing entry on January 1st. That's typically the case. We usually do the reversing entry on the day after, even though we didn't make the payment until the 15th of January. So you could say, well, why didn't I just do it on the 15th? Because that's when it would all wash out perfectly. And the idea is that I want all my reversing entries as of the same day so that I know where the reversing entries are. And I'm okay with the fact that it's not perfectly correct for 15 days until we make the payment, because that's the concept of adjusting entries. I just want to make sure that they're correct periodically at the end of the periods, month or year, so that we can make the financial statements. And then I want to do what's easiest logistically to just enter the books as easily as possible. So I'm gonna close this back out. And the other side, so when we reversed this out, we had the gain or loss that went on this side, and then the other side went to the accounts payable on the balance sheet. So on the balance sheet, if I go into the accounts payable, we are now at, and I changed the date to the 22nd. We have these two items then there. It's entered as of the cutoff date to be correct as of the cutoff date, and then we reverse it right after, so that when we enter the bill, again, it'll do the adjusting entry for us. It'll enter the three, the three accounts will be affected. It'll decrease the accounts payable by basically the amount of the bill. It will record the decrease to cash and the change to the gain or loss account, which will be the change for the entire period between the two rates, and that'll wash out to be in the correct allocation between last year and this year on the income statement due to our adjusting and reversing entries. So we'll see that completion next time.